Recently, my co-host on the BiggerPockets Money podcast, Scott Trench, who happens to be the CEO of BiggerPockets, recently made a huge investment move, and that is what we are going to talk about today. Hi there, I'm Mindy Jensen.
And I'm Carl Jensen.
And this is the Mindy
and Carl
on Living a Fi Life, where we talk about what happens after you reach financial independence.
Why do we call this show Living a Fi Life?
Because we're talking about and talking to people who are living their best life after they have reached financial independence.
Yeah, and before we get into this, I just want to say that Scott's a pretty incredible person. I'm fortunate to have known him for years, so I don't think there's anything to criticize here. It's just an interesting decision that we would like to discuss. Tell us about Scott's move. Tell us what he did. And he posted this publicly on the BiggerPockets Money Facebook channel, correct?
Yes, he posted in our Facebook group, which is at facebook.com/groups/BP Money. If you have not yet joined, go hop on over there. There's lots of conversations. Scott posted in early January, there's something bugging me about the 4% rule lately. I mentioned last week that I'm reallocating my portfolio to real estate. It's a portion of his portfolio, not the entire amount. Today, I asked myself why I never even considered bonds. The answer, bond yields are so low and so tax inefficient outside of my retirement account, was so obvious to me that I never even asked the question initially. I'm not going to invest in Vanguard's diversified bond portfolio at 3.67%, 4.5% yield to maturity, when I can get a 4.25% yield on a money market or a 4.6 yield on 10-year U.S. Treasuries. Turns out most of BP Money listeners don't bother with bonds at all either. Link in this Facebook post is to a recent poll I posted in the community. This gets me worried. Is our community literally 100% in index funds? This is a great approach as one builds wealth, but a good chunk of the community is currently wealthy and they are totally exposed to the market. 4% rule and index fund investing are used interchangeably. They are not the same thing. Relying on the 4% rule means relying on a 60-40 stock bond portfolio. I worry that a lot of people who are nearing the end of their FIRE journeys or think they are, but are 100% invested in stock market index funds with little else are at extreme risk that made a lot of sense in the early accumulation stages, but does not make sense towards the end of the journey. And the solution the 4% rule offers, rebalanced to diversified bond funds yielding less than 4%, is not a solution that more than a tiny fraction of this community will actually implement, even if it is textbook. So what should one do? So what Scott ended up doing, and we've covered this in a recent episode of the BiggerPockets Money podcast, he ended up selling about 40% of his index fund portfolio and turned it into real estate, rental real estate. He bought a fourplex in Denver. He is experienced in real estate investing. He's experienced with the Denver market. He knew that this particular property was a really good deal. So while I think that his thought process is like, first of all, he thought about it. He didn't just say, oh, I read something on the internet, I have to make a change. He went through a big thought process, as one does when you are Scott Trench. He's very cerebral. He decided that he didn't want to deal with the stock market crash. He didn't want to wake up one day and discover that his portfolio was worth significantly less than it was just a few short weeks before. So he decided to pull that out and buy cash flowing rental real estate. Now, he did get a great deal. I actually helped him buy this property with regards to acting as his real estate agent through the process. And I think it's a great deal. I think it's a great property for him. I think he's going to have a lot of success with it. But I caution anybody who hears, oh, Scott sold his portfolio and is moving into real estate, I should do the same thing. First, you need to make a lot more assumptions. Carl, what is your thought about Scott selling his portfolio? A portion of his portfolio. He's still 60% in the stock market.
Yeah, so I'm curious about one thing you said. He was concerned about a drop, and I believe he had another post where he expressed a little bit more about that. Like he had a concern about valuations of the market. He said everything's high and it doesn't feel quite right. Is that correct?
That is correct. He says that the valuations are, I think, 29 or 30. The PE ratio is 29 or 30, and that was giving him a lot of anxiety because it's so high. Carl, before we get into your thoughts, I want to reiterate what Scott has said multiple times. He is not predicting a crash. He is not, saying anything negative about, what is going to come from the stock market. He's just saying his own personal feelings. He doesn't want to go through that. So should there be a stock market crash, he wants to hedge his bets. He wants to move more towards that 4% rule, 60-40 split, but he's not super excited about bonds.
Sure, and that's what some of this discussion was motivated by, in that he was mostly in index funds and he wanted to be diversified a little bit. I think he just happened to notice that the markets were highly valued and thought now would be a great time to do it, which is great. We'll talk a little bit more about his decision in a little while. But before we talk about that, I'd like to zoom out a little bit and talk about the stock market in general, how we got to this place. So the past 2 years have been incredible, right? In 23 and in 2024, the markets have had about a 25% return. That is incredible. Just to be clear, the average historical return with dividend reinvestment is about 9 or 10%. In 8 of the past 10 years, the markets have been up. In 6 of those years, we've had returns of over 20%. And in 2019, we had a 30% return. So the past 10 years have been a very, very, very good time to be on the market. If you are on the sidelines with cash, you're probably not that happy now. And it's true. All this has resulted in high valuations. And before we go into this, we have to have a little bit of a nerd talk. Sorry, I'm a nerd. Is that right?
Yes.
On a scale of 1 to 10, where am I on the nerd scale?
11.
11, a Spinal Tap reference. I love that. Spinal Tap, the movie, one of my all-time favorites. So we measure market valuations by PE ratios, and a PE ratio is the price of the stock divided by the earnings. I'd like to throw out a real simple example so people can understand this. If you're looking to buy a rental house and the house costs $100,000 and it returned $20,000 a year in rent, very simply, that would give you a PE ratio on the house of 5, 100,000 divided by 20. And that would be pretty good. Let's say that same house was 500,000. The PE ratio is now 15, which isn't quite so hot. You're paying more. You're paying a lot more to make the same amount of money. And that's how we can look at stocks and the stock market too. The P is the price you're paying. The earnings are what you get out of it. That constitutes the PE ratio. The current PE is, when I wrote this outline, was 30.36, and the historical mean going back to the 1800s is 16.13. So we are almost double what the historical PE is, which is pretty crazy, right? Like, how many people would want to pay 2x for the house that returns what it would have returned like 5 years ago or something like that? They wouldn't. You're paying a lot more to get a lesser return.
Exactly. I
started thinking about this. This leads to some other questions. Are there any reasons it should be this high? I think there's a couple of them. One is stock market participation rate. Like, when I was a kid, I don't ever remember talking about the stock market, or I don't think 401ks were even a thing. Maybe they were. Do you know when 401ks or IRAs, Roth IRAs were invented?
The 401k was introduced in 1978. And the Roth IRA didn't become available until 1998.
So the 401k became a thing in 1978, and the Roth IRA was much later in 1998. Yeah, so I'm looking at my favorite website. It's called Multiple to research this, and it's only been this high like 2 other times in history. Let's see here. One was around 2000. We all know what happened right after that. And another one, I believe, was, during the COVID times. And the reason for that was everything crashed. The PE, the denominator in that, the earnings went way, way, way down, raising the price of the PE ratio. It's only been this high 2 other times in history, which is pretty crazy.
Okay, so what are you saying? Is Scott right? Should we start pulling our money out?
We are not giving financial advice.
I'm not asking for financial advice. I'm talking about you and me. Are we going to start pulling our money out based on what you just said?
You know what I think we should do? Do you remember the Beanie Baby craze?
I do remember the Beanie Baby craze. One of my favorite stories coming out of the Beanie Baby craze was a divorce where there's a picture of these 2 people in the courtroom. There's this giant pile of Beanie Baby stuffed animals, and they are picking through, like, she gets one, he gets one, she gets one, he gets one. And all I could think of is, why? They're not actually, what are they worth now?
This is probably going to trigger some people, but Beanie Babies kind of remind me of cryptocurrencies.
You can email Carl at biggerpockets.com and tell him all about your cryptocurrency commentary.
I'm gonna get the hate mail.
You are.
So anyway, everything is cyclical. So I think Beanie Babies are going to make a comeback. So I think we should pull out 40% of what we have and invest it in Beanie Babies. We should just go on eBay or wherever you buy those and buy all we can.
You can buy them by giant bagfuls at the thrift store.
We'll go back to the thrift store and see what they still have. They probably have more.
Are you comparing the stock market to Beanie Babies? Because I'm going to have an argument with you if you are.
I am not comparing the stock market to Beanie Babies, and we are not actually going to do that. But here's what we probably will do, and spoiler alert, it is pretty boring. We are probably going to do absolutely nothing. You still have income. We are not drawing down from our portfolio. So over the long term, none of these things matter. If you were to leave your job, I think we would sell some of our assets to have a little bit of a cash cushion to sit on. But as of now, we're just not going to do anything. Over the long term, it goes up and to the right. So we don't want to be left out of that. And also, these things are impossible to predict. I remember in 2013, when I started becoming interested in all this, there were people back then saying, the valuations are high. I'm just going to keep everything in cash. And I don't know if those people actually did that, but if they did do that, they're not thrilled with themselves right now.
They probably aren't. And like I said, Scott and I had a discussion about why he was doing this and where he was putting his money and what I was going to do. And I told him that you and I were going to continue to be in the stock market for the foreseeable future. We don't have any plans to pull money out of the stock market at this time.
I think what Scott didn't do, going back to him, is really important. So what he did not do is he did not move everything to cash. If he did that, I would definitely have an issue with that. He moved it to another asset, which he is equating to bonds. So he's diversifying into that 60-40 portfolio, which is what the 4% rule is supposedly based on. Is there a Beanie Baby like 4% rule? We should look into that.
I think you need to have 4 billion Beanie Babies in order to buy a cup of coffee.
I've always admired Scott. We've talked about this a couple weeks ago on a podcast. He's one of the people who is equally comfortable in real estate and the stock market. Real estate is great, but you have to do your research and you have to know what you're doing. And Scott definitely has that. So I really respect and appreciate what he has done here. I think he is going to, I think Scott would end up well no matter what he did, but I think this was a good move, which equates to his goals and what helps him sleep at night too. And that's what this all should be about, right? If what you invest in and what you do keeps you up and gives you anxiety, maybe you should give your money to a CFP or think of a different direction. But I like what Scott did here.
I like what Scott did here for Scott. First of all, he thought about it. He thought long and hard. He did research. He looked into historical returns. He looked into his own self and how he would handle a potential stock market drop and decided that he wanted to make a change. He didn't make a rash decision. He thought about it for a while and then decided this is the decision I am going to make. He took one asset, and like you said, he didn't put it into cash or Beanie Babies. He took one asset and exchanged it for another asset. Carl, you and I do this all the time. Usually one stock to another stock. We did recently sell some stocks to go into a private equity position. But again, it's just a stock in a company that isn't publicly traded yet. So we are more comfortable with that kind of risk. Also, I would like to point out, you and I are significantly older than Scott. We have been through market downturns, and I don't think he has been through a big market downturn yet. And that doesn't make him a bad person. That doesn't make us better because we have been. It's just a different thought process and a different mentality. But it all goes back to Scott made this decision after thinking about it, after doing research, after deciding that this was the right decision for him. Not because some schmuck on the internet said, you should totally do this. He's like, yeah, I guess I will. And that's what I want everybody to take away from his decision is he really considered this before he did it. A
couple of thoughts before we wrap up. If you are still investing, like if you're working and putting money into the stock market, you should actually want a downturn. One of my favorite investing quotes comes from the great Warren Buffett, who says the stock market is the only store where people rush for the exits when everything goes on sale. And that's so true. Like whenever there's a downturn, people freak out and sell, which is the exact opposite thing of what you should be doing. Again, consult your investment professional. And if you still have 10 plus years for when you're going to access this money, who cares? Any correction is going to be a blip decades from now. Can you imagine if you sold when COVID caused the market to dip? And I'm going to go back into nerdom now. I love technology. I follow all this stuff very closely, and artificial intelligence is going to be a thing, and it'll probably be a very big deal this decade. If you research why the market goes up and to the right, it is because of productivity gains. So productivity gains allow companies to make more money from producing the same thing because they do it better, more efficiently, blah, blah, blah. Artificial intelligence is the ultimate increaser of productivity gains. Humans won't be doing the work. Computers and robots will. And I don't think people realize what's upon them. So if you believe any part of this, we could be on the cusp of another great market upturn. It could continue to go up. This is not investing advice. I'm not personally doing anything because of that, except keeping our money in. But I think the future could be pretty good. If nothing else, it'll be very interesting.
It'll definitely be interesting. I also believe, I mean, we're married and our portfolios are kind of combined, but I also believe in the strength of the American economy. So I am going to continue to be in the stock market. I'm going to continue to encourage you to stay in the stock market, Carl, and we'll see what happens in the next few years. All right. If you like this video, please give it a thumbs up and don't forget to subscribe to this channel for more videos with Carl and I just like this.
Thank you so much for joining us for Living a FI Life. And with that, Mindy and I say goodbye.